Bernard Borges is here to talk to you about a very important concept that has been out for decades, but new to us in our community. It's the whole life, traditional whole life versus a generational program called an IRS 7702 plan. I'm going to identify to you the differences between the two plans utilizing the same concept. Normally, an average whole life plan is $20,000 that normally you pay about $100 for. So if you take that and annualize it, times it by 12, you pay $1,200 a year for it. On average, the whole life policy lasts about 30 years. So we take 30, times that by the 1,200, that gives you $36,000. That's how much you put into the plan, but yet you're only getting $20,000. So we already got a problem, but it gets worse. Because of the rule of 72, the insurance company can take your money, the life insurance company, and use the magic of compound interest. And over the last decade, that's been performing at 6 to 10%. We're gonna use the middle number and say 8. So the rule of 72 works like this. 72 divided by the interest rate that we're using, in this case 8, equals the amount of years that it takes in order for this money to double. So every 9 years, it'll double. In a 30-year period, 9 goes into that 3 times. So we're gonna double it 3 times. So we're gonna take 36,000 and times that by 2, that's 72,000. Take the 72K, times that by 2, that's 144,000. And then take the 144 for the third time, double it in that 30-year period, and now it's 288,000. Now that 288, we're gonna actually take out the death benefit when the insured passes away. So that leaves you now with your death benefit of $20,000. The insurance company takes $268,000 of your money that they get to keep. That's why they have the tallest buildings and arenas named after them in every city. However, we're gonna change that narrative. This is how we're gonna do it. First and foremost, we're gonna use annual renewable term instead of whole life, which is gonna give you a bigger face amount, usually 3 to 4 times the size of the face amount for the same amount of money. So let's just say 80,000 for this example. Now you're gonna use the same numbers, $100 times 12 is gonna equal $1,200 a year. But we're gonna times it by 30 year with the 7702 plan, which is a private bank. So it's not a life insurance plan. So now your 36,000 that you've put in is still much less. If you pass away, you're gonna still get $80,000, not 36. So that's already a benefit. Secondly, this money now with the rule of 72 is gonna compound in your favor instead of the life insurance company's favor. Again, 6 to 10%. We'll use 8, so we know that's 9 years. It's gonna double. So every 9 years is gonna double. So 36 times 2 is 72. Now keep this in mind. This money's locked up. You can't get to it. All you get is the 20,000 when you die. This money after year 1 is available. It's liquid. It is your bank account. So that's 72,000 after the first double 9 years. If you want to pull this out and buy a car, buy a house, go on a worldwide vacation, whatever, you can do that. But we're going to keep going. Let's say you leave it alone. 72 times 2. Now you're at 144,000. Okay, and then we do it one more time. 144 times 2 is 288. Same 288 as over here. Here's the difference though. The plan has fees. Of course, they got to get paid too. So the 288 minus the 20K in fees, not 20K death benefit, but 20K in fees, leaves you with 268,000 that your family and you can use for retirement, again, for whatever it is that you want. Plus, you're going to get living benefits, which simply means that you are not entitled to money only when you die. You're entitled to money if you can't perform 2 of the 6 daily living activities, which includes, cleaning yourself, getting out of bed, feeding yourself, and some other ones. But the idea is if 2 of those you can't perform, whether you're chronically, critically, or terminally ill, you will get a large percentage of that face amount, even while you're alive, to protect your mortgage, utilities, and groceries. Not medical expenses. You should have insurance for that. In addition to that, all this money is tax-free. The IRS, just as the IRS, and they say, as long as the funds are being borrowed, which they will be from this account, your private bank, you will get the monies tax-free. You'll never have to actually pay for that. So In conclusion, do you want $20,000 going to your family as a death benefit for whole life? Or do you want $268,000 for you to use while you're alive and to go to your family upon death? Because actually, once this number reaches higher than 80,000, you don't get the 80,000, you get the money in the accumulated account. I hope this helps. I hope this clears up some discrepancies, and take advantage of the 7702 plan as our millionaires and billionaires all around the country are. Thank you.